Have we determined if I have a good side yet, or are we shooting straight on because they're both equally bad? Kind of like my tennis stroke.
You can try.
Welcome everybody to this week's commentary. This week we're going to look a little bit deeper at an acronym I mentioned offhand in last week's video that again is a big component, framework if you will, for how we work internally as well as with clients in evaluating their financial plans, their portfolios, and even their individual positions. That acronym is L.I.V.E. and it has four key components that we want to make sure to address: liquidity, income, volatility, and expected return. And the key really, again, is finding a balance between all four of those things for each person's unique story. Running money, managing wealth, again, not a theoretical exercise, but a practical one. Too often times people look at something like expected returns and say, well, we should have just invested in this, it would have done the best. But you got to take into account that markets, life have a lot of unexpected twists and turns. You're going to need liquidity at certain times. You're going to need income generation at various points in your life cycle. We all can only put up with so much volatility. And again, we all need to have some type of a return on our investments to help us build wealth. So with that, we'll take a look a little bit deeper at each one of these four components. Liquidity, real simply, how quickly can you get your hands on that money? If you think about something like cash or US Treasuries on one end of the continuum, extremely liquid, you can get access to them really at any point in time. On the other hand, you might have something like a physical piece of real estate or a private equity investment or even a certain small cap stock, something that's less liquid, less thinly traded. You may be able to get your hands on it, but take a cut as a consequence, or you simply may not be able to sell it. There may not be a buyer at the time you need to sell that you can get out. Second piece is income. And again, we touched on this last week. The reason income generation is so vital is if your investments are generating an income level commensurate with what you need, then you're not going to be able to force to sell to supplement that. And so you then are empowered to sell when you want to, as opposed to when you might need to. And that's, again, an important thing to keep in mind. It's often a cousin of liquidity. If you're generating enough income again, maybe then you can take and have a little less liquidity somewhere else in your portfolio because you're not going to need to sell any or all of that portfolio because of the income generation. So again, these things not only are trade-offs, but they also work in tandem with one another if you can find the right balance. The third component is volatility. And volatility really has two different aspects to it. One is psychological. All of us really have a certain emotional point at which we crack, and whether that's just stress of life. I have a good friend who was a SEER instructor for a number of years, and he would talk about, hey, look, everybody has their breaking point, right? And one of the things he would work with soldiers with is helping them understand that might be a little bit more than they think, but again, not pressing them to that breaking point. Same thing with investments. We've covered this before, that your brain and how it responds to mortal dangers and trauma is actually the same way it responds to losing money. And so really making sure, again, we take that into account of really what is that point, because we never want to go past that at a point where then you would sell again at an inopportune time. The second piece is financial. The reality is there's volatility not just to markets, but to life, to needs. Unexpected things come up. That could be something difficult like getting laid off or having an unexpected bill or expense rise. It could be something really positive like a trip you want to take or a new dream that you want to be able to pursue, or your child getting into their dream school, but that dream school costs a little bit more than you might have expected. So making sure that we have, again, a plan built for all the unexpected twists and turns that can come our way. Finally is expected return. This is obviously the most common one that people think about and want to maximize. And we've talked previously about how, look, you can beat the S&P 500, at least historically looking, by investing in small cap value stocks. But the problem with that within this continuum is they can not necessarily be as liquid as one might need. They don't produce a whole lot of income. They're extremely volatile. And so again, taken in totality, is that something that's really going to work with your overall plan? It might work for a piece of it, but having that myopic focus of simply trying to maximize return might not work for any of those previous three reasons. In summary, what we hope this framework can do is inform your decisions. How are you building your plan? Is it taking into account these 4 different aspects? Does your portfolio then reflect all of these? And of course, can even be used to evaluate a singular position. You might have a great return, but are you taking too much risk to get that return? Are you giving up too much liquidity? Is it giving you the income you need? All of these things need to be considered when one's looking at their financial plan in any of its aspects. Too often, again, without this framework, you see people who maybe they overemphasize liquidity or volatility reduction, and therefore they have a bunch of cash sitting in the bank account, not generating the income that they may need, not generating the expected return they may need. On the other hand, people who get way too overweighted into real estate or private equity or more speculative investments, seeking that maximum return, maybe seeking great income generation, but not realizing that they've given up a great deal of liquidity, or they've perhaps invested in things that are going to have a volatility associated with them that's far more than they can have. We hope you found some value in that. Look forward to being able to unpack this more in the weeks ahead. Thank you so much for all the messages, support, shares of the messages that we've been bringing to you. We're glad that you like them. As always, questions, comments, ideas are welcome. Next week, we'll look at this framework specifically as it does relate to individual security selections or positions within a portfolio, and how our approach, again, differs from what some of you may have seen elsewhere. Thanks so much.